All right, welcome back. You know, when we're playing the stock market, we're supposed to buy low and sell high, but it turns out many people do exactly the opposite, which costs them money. Financial professional John Vandergriff from Blue Ridge Wealth Planners joins us right now to explain why we make those bad investment decisions and how we can prevent them in the future. So first of all, John, let's talk about what is behavioral finance.
And so this is, where psychology and finance come together. When people study finance in college, a lot of the financial world is built on perfect decision making and perfect portfolios. And the reality is mixing people with perfect sometimes doesn't work. So, so we've got to analyze how do people actually make decisions about their money and try to create pathways or situations where we can avoid making those bad decisions that we are tempted to do, whether it's emotional or behavioral.
All right, so then let's talk about making that decision to reverse it. You're supposed to buy low, but you sell low and buy high. So what's going into this decision process?
Yeah, so when you look at the way people make decisions, the two primary drivers are either fear or greed. And so when we look at it, times where the market is, in the air, kind of like it is right now with all the stuff that's going on in Ukraine, people are tempted to sell because they're afraid that it's going to get much worse. They don't want to lose everything they have, which, as we know, the opposite should be true. This is a really good buying opportunity for people that may be on the sidelines. On the other side, when you have a market that's been really successful, people have a fear of missing out or making that money. And so they say, well, if everybody else is doing it, why don't we get in? And then that's usually the time. And so Warren Buffett has a good saying, and I'm going to loosely paraphrase. He said, whenever everybody is fearful, that's when you want to get greedy. And whenever everybody else is greedy is where you want to get fearful. You want to try to move in the opposite direction of whatever that popular opinion is.
I kind of like that. So as far as biases, when we're looking at this, when it comes to something making these decisions, is that way heavy?
Well, it's as you drill down in the layers of behavioral finance, you'll have things like confirmation bias, where if you only research things that support what you already think, then you're more likely to go down that path. And it's like, that's pretty much social media by definition. Then you have mental accounting, where people will justify dollars in a different way, like tax refund money versus paycheck money. You treat it totally different. The key is understanding that these biases happen, and even one that people are walking through right now with loss aversion. Sometimes people worry about losing money more than they actually care about making it. And so when you have those things present, it will cause you to make different decisions.
So how do we avoid this then?
Well, I think the big thing is trying to add some logic back into the mixture. If you feel tempted to do something naturally, you want to try to have something that you can anchor back to, whether it's a plan, whether it's somebody that can help you kind of stay on the right path and be a sounding board for that, just so that you can avoid taking that step that you're tempted to do, but may be in not your really best interest, especially in the long term.
Somebody like you, we can pick up the phone and give them a call.
Somebody like us, and so again, what's interesting, we've done a lot of podcasts and different things. So if you've got questions about behavioral finance, you can go to BlueRidgeWealth.com. We've dug a little deeper into some of these areas. It's an interesting field to study. So
always good to check out before you make a big move. Thank you, sir, as always. Lori, back over to you.